Hard work pays off in most areas of life, but in the stock market, extra effort often acts as a tax on your returns. Does putting more time into your portfolio actually yield higher wealth, or are you simply paying for the privilege of working a stressful second job? Meet Tyler, Greg, and Ryan, all 30, investing $1,000 monthly to retire at 60. Tyler is a day trader, executing hundreds of trades. Greg is a swing trader, holding for weeks. Ryan exerts zero effort, passively buying one index fund. The math over the next 3 decades exposes a brutal reality about how wealth is actually built. We have to determine if Tyler's massive expenditure of time and stress builds more wealth than Ryan's complete apathy. For the first couple of years, Tyler feels validated. He hits a hot streak, seeing weeks where he's up 4%. He has the screenshots to prove his strategy works, and every profitable trade reinforces the story that he has found a clear edge. Ryan has nothing to screenshot. His passive index fund simply grinds along, ticking up and drifting down with the broader market. There are no bragging rights and no massive single-day gains to talk about at a barbecue. While 80% of day traders lose money, we are going to give Tyler the absolute best-case scenario. For this test, we assume Tyler is in the top 20% who generate a gross profit, eliminating the excuse of poor performance. Even with that optimistic assumption, feeling like a winner in the short term is a dangerous psychological illusion. While Tyler celebrates his daily wins, Wall Street knows exactly how the math works for retail traders. The structure of the market systematically drains those profits before they ever reach a retirement account. The primary unavoidable wealth killer for any active trader comes straight from the government. When you hold an investment for less than a year and sell for a profit, the IRS taxes that gain as ordinary income. For Tyler, earning $75,000 a year, that means 22% of every winning trade is immediately owed in federal taxes. This chart shows the behavior of uninterrupted compounding over 30 years. This is Ryan's passive strategy. Because the capital remains invested without triggering a taxable event, the growth curve bends upward exponentially. Every dollar of profit stays in the account to generate its own subsequent gains. Watch what happens to the active trader. Because they take profits within a year, the line drops sharply at the end of every 12-month cycle. They are permanently hacking off a fifth of their gains to pay the tax bill, starving the compounding engine of its fuel. The passive indexer pays none of this along the way, deferring taxes for decades. By year 20, the difference between untouched compounding and heavily taxed compounding creates a massive chasm in net worth. By executing hundreds of short-term trades, you legally force yourself to hand a fifth of your success to the IRS every single year. This mathematically sabotages your own exponential growth. Beyond taxes, a hidden cost eats away at the active account: market friction. Every time you push the buy or sell button, you pay a microscopic toll in the form of spreads, slippage, and occasional fees. This flowchart illustrates how those tiny cents amplify into structural drains. When a day trader turns their account balance over 20 times a year, their capital is constantly moving through this loop. With every cycle, tiny slices break off. The math on this turnover is ruthless. Looping capital 20 times means roughly 2% of the account's total value evaporates into friction every year before the trader has realized a single dollar of profit. This relentless friction is a constant headwind. It exists entirely independent of how well the broader stock market is performing or how accurate the trader's individual stock picks are. The stock market doesn't need to beat the active trader. The trader's own frantic activity does the job for free. You might look at Tyler's daily chaos and assume Greg has the right idea. He is our swing trader, holding positions for weeks to ride clear trends. It feels like the responsible middle ground. There are genuine benefits to this approach. Greg isn't chained to a monitor all day, and because he trades less frequently than Tyler, his friction costs are significantly lower. But his strategy has a fatal flaw. Because Greg still holds almost everything for less than a year, nearly every gain he captures triggers the same devastating 22% short-term tax burden. The bleed is slower, but he is still bleeding. He also faces the statistical reality of market timing. Investors who attempt to jump in and out of trends consistently underperform a basic buy and hold strategy over the long run. Shrinking transaction costs doesn't eliminate the primary wealth killer. Greg's middle ground provides an illusion of safety while leading him toward a slower, more deliberate version of underperformance. This graph tracks the final 30-year net worth for our three identical starting inputs. By year 10, the lines begin to separate, and by year 30, the final score is undeniable. Tyler, our active day trader, lands at $511,000. Greg finishes around $812,000. Ryan, the passive indexer, ends with $1.77 million. Doing absolutely nothing beats the hardest worker by over $1.2 million. We've measured the cost in dollars, but we have to evaluate the cost in time. Tyler watched the market and prepped his charts for a few hours every trading day. Over 30 years, that equates to a staggering 60,000 hours of input. Ryan spent perhaps 4 hours a year occasionally checking his app. Over those same 3 decades, his total time investment was roughly 120 hours. 60,000 hours represents an entire second career, worked over 3 decades alongside a primary job. By chasing the market, Tyler sacrificed 60,000 hours of his life to finish $1 million behind the person who did nothing. The math gives us a clear roadmap. Step 1 is straightforward. Dedicate the vast majority of your wealth building to low-cost index funds. This guarantees maximum tax deferral, minimizes friction, and lets exponential compounding do its job. Step 2 is the casino rule. If you biologically crave the dopamine of active trading, you do not have to pretend that need away. Instead, you strictly quarantine it. Take a maximum of 5% of your portfolio and wall it off from the rest of your assets. Trade that small slice and scratch the itch, but accept that you might lose it. By capping it at 5%, your trading cannot destroy your primary wealth engine. If you must trade, execute those trades strictly inside a Roth IRA. This tax-advantaged account shields you from short-term capital gains taxes, eliminating the biggest drag on your active returns. Finally, step 3, demand a real scoreboard. Measure your trading returns against what a basic index fund did over the same period, and count the hours you spend looking at charts as a strict hourly expense against your portfolio. Financial success depends on disciplined patience rather than the volume of your daily activity. This framework ensures the market works for you rather than you working for it.